A very good afternoon to our audience today joining us on the weekly market review. Today is the 4th of August, and I have with me Gerald. How are you, Gerald?
Hi, Sunny. Hi, everyone who has joined us today. So we are now into a new month, August. I think everyone will have seen a lot of the SG60 celebrations that are going around. It is also a very busy week for the earnings season in Singapore. So we'll be sharing some of these updates in today's weekly market review.
Yes, amid all the SG60 and NDP celebration, a lot of things is happening on the market. We ended July, which was a pretty good month, but we started August somehow on a negative note, led by, of course, the start of the US tariffs and, of course, the jobs numbers that came out for the month of July was not very optimistic, and there was some revision downwards of the previous month as well, showing that the tariff is starting to bite the economy. So some of this development will be covered today by Gerald, so I will not take up too much time and let Gerald take us through the details.
Sure. Okay, the usual disclaimer that today's sharing is for informational purpose only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So in the past week, we saw a slight pullback in the markets. The S&P 500 was down by 2.4%. The STI is down by 2.5% and now back to below the 4,200 levels. This was mainly driven by the decline that we saw on Friday with the weaker than expected US jobs data. Okay, so in the previous weekly market review, we shared that is something that we are keeping a very close lookout for. And what we have seen for the July data is that it has come in below expectations. And that would effectively also see that the May and June numbers were revised downwards, which means that on average over the past 3 months, we have just seen job growth of about 35,000 per month. So I think that actually led to concerns about the health of the US economy, especially after the announcement of the trade tariffs. So with that, we have seen a very significant pullback also in the US government bond yields. Just on Friday alone, we see that the bond yield fell from about 4.4% to about 4.2%. So a fairly sharp move within a single day and reflecting the concerns about the health of the US economy with the weaker than expected jobs data. And with that, we have also seen increased expectations of US Federal Reserve interest rate cuts. So if I were to look at the upcoming meeting in September, based on the CME FedWatch 2, the probability of a rate cut is at about 80%. And that's actually increased after the announcement of the jobs data. So effectively, investors are now expecting that the Fed will accelerate on the rate cuts given the deterioration in the US economy. In the Singapore market, given the pullback in the market, we saw very few stocks with gains in the past week. In terms of the STI, the top performers were Venture, Keppel, that announced stronger than expected earnings, as well as SGX. In terms of the worst performers, we have quite a number of names in here, including some of the industrial names like Singapore Airlines, SATS, Seatrium. So some of these names have actually seen some pullback with the earnings, especially for Singapore Airlines. So I wanted to go through in a bit more detail the earnings for Singapore Airlines. We see here that with the announcement of the earnings, there has been close to a 10% decline in the share price from above $7.50 to now about $6.80. So in terms of the first quarter earnings for SIA, which is the quarter ending June 2025, the net profit actually came down by close to 58.8%, to 186 million from 452 million in the same quarter last year. So while revenue was still a slight increase, the expenditure went up, and that actually led to a decline in the operating profit. So here we see the revenue of SIA. I mentioned earlier that it still managed to grow by about 1.5%, mainly because of the improvement in terms of the passenger flown revenue. The cargo revenue came down slightly on a year-on-year basis, but overall, with the larger contribution from the passenger flown revenue, they were still able to report a slight growth in the revenue. So this is what we see for the group passenger load factor, as well as the capacity that they have over the past quarter. What we see here is that it has been fairly stable. And with that, they have been able to grow their revenue within the passenger flown segment. I mentioned earlier that the expenditure went up. So effectively, most of the increase came through from the non-fuel expenditure. And at the same time, we saw a slight decline in the fuel cost. So overall, we saw a increase in the expenditure by about 3.2%. So with the 1.5% increase in revenue and sharper increase in expenditure, the group operating profit came down by about 14% to 405 million in the latest quarter. What is also important to note is that while the operating profit saw a moderate decline, the group net profit saw a more significant decline, and that was driven by the losses of associated companies, notably from Air India. Okay, so that put down the group net profit by about 122 million, and that led to a 59% decline in the group net profit. Okay, so that in a nutshell is SIA's earnings. While the revenue has been stable with the increase in expenditure as well as the losses from associates, particularly Air India, we saw a fairly sharp decline in the net profit, which actually led to the pullback in SIA's share price. Next, we have OCBC, where it has also come down slightly following the earnings that were reported. So in the first half of the year, we saw OCBC's group net profit down by about 6%. Overall, this is largely driven by the decline in the net interest income, which fell by 5% in the first half of this year. So likewise, if I were to drill down and look at the second quarter earnings, the net profit came down by 4%, and that really came through from the decline in the net interest income, which was down by 6% on a year-on-year basis. So if you're wondering what led to the decline in the net interest income, this is mainly because of the fall in the net interest margin, which came down to about 1.92% in the second quarter of this year from 2.2% in the second quarter of last year. This is really because of the fall in interest rates that we have seen that is leading to this decline in the net interest margin of OCBC. So overall, in the first half of the year, the net interest margin has declined to 1.98% from 2.23% in the first half of last year. What is helping OCBC's earnings is that the non-interest income is still growing. So if I were to look at the first half of the year, the non-interest income grew by 8% on a year-on-year basis. In the second quarter, that grew by 5% on a year-on-year basis. So that has helped to mitigate some of the impact from the lower net interest income. So what is driving this growth in your non-interest income? The fee income continues to grow, and a big part of that is coming through from the wealth management fee income that rose to 279 million in the second quarter of 2025 from 212 million in the second quarter of 2024. So what we have seen is increase in the asset under management of OCBC, and with that driving a higher wealth management fee income. In terms of the OCBC's financial targets for 2025, they are guiding for the net interest income to be lower by mid-single digit percentage, and that is really driven by the decline in the net interest margin, where they expect it to be in the range of 1.9 to 1.95%. In terms of the credit cost, they expect that to be still manageable at about 20 to 25 basis points. And overall, they are sticking to their dividend payout target of 60% for the full year of 2025, plus the share buybacks that were previously announced. So this is what we see for the dividend payout of OCBC. Interim dividend of 41 cents, which is a decline from 44% in the first half of 2024, and that will represent a payout ratio of 50%. Okay, so that would be the earnings of SIA and OCBC, which were two of the key earnings in the last week. Coming into the current week, we see more earnings reporting by Singapore companies, including the earnings by DBS and UOB on Thursday, the 7th of August, as well as quite a number of other REIT results in the coming week. So with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks, Gerald, for that coverage on the OCBC and SIA earnings. So over the weekend or the past 1 week, I do get some questions from some of my friends and industry peers to ask me on what's the outlook of STI like. So just to recap, last week on the weekly market review, I mentioned the JP Morgan report that the base case of their target for year-end target STI will be 4,005 with the best case at 5,000. So I believe that scenario still stands today, even though we see a very negative first week start to the beginning of the month of August. So traditionally, August has been one of the weakest months during the whole year. And you can see from this chart, this is where the STI has been performing the whole of this year. Okay. So from where we see last Friday, we saw that first negative session, okay, which was the first in, I think, more than 10 consecutive winning session for the STI. So the pullback that we saw last week, I would deem it as still healthy, and the long-term or the mid-term uptrend is still very much intact. Okay, so I'm not too worried that they will miss the scenario that JP Morgan has suggested. So I'm still aligned with that target. And if you look at the STI index, we will pull down by a major part of it by OCBC result, which was a key component of the STI index. Okay, so the worry here is coming into this week, we will also see DBS and UOB earnings on Thursday. So with the net interest margin being pressured, net interest income being pressured, the STI is likely to face a little bit more pressure. Okay, but looking at the REIT index and some of the REITs performance, some of the REITs and property counters, they are still performing very well. So STI will not be very much impacted. So with the EQDP program in place as well, I think we would be able to sort of continue the uptrend that we have been seeing so far. So some of the key levels that we are watching, of course, the high now is set at 4,274 points, which was the high that we saw on 24th of July. And we are now trading around the 4,170 points level. So this Monday morning, we are up about 20 points or 0.5% on the STI index, which was the reason why I'm not too concerned that this pullback would sort of exacerbate or accelerate downwards. Okay, key support level now, I think in the past 3 or 4 weeks, we have been sort of pretty optimistic, okay, or sort of complacent on some of the global indices as well. So the return back to the 20-day moving average at 4,167 points is actually a healthy pullback towards the 20 days moving average. So the next key support level will of course be the lower bound of the Bollinger Band at 4,035 points, finding confluence with the 50 days moving average at 4,026 points. So with these two support coming in, STI around the 4,030 points level would have a very strong support. And at this point as well, we also see that was around the high that we saw in the March period as well, before the tariffs kicked in. So this is a previous resistance level, could also have a change in polarity for technical traders, and hence further support the STI index around the 4,030 points level. So if you're looking at getting back into the STI rally, if you have missed the previous one that I highlighted over here, which was the rally from 24th June to the 24th of July, this 11-point gain, this pullback is actually an opportunity to get back into the safe haven names on the STI index. Okay, so key support level towards 4,030 points. My personal opinion, 4,100, we should see some quite strong support coming in. MACD indicator still negative. That's why my opinion that it will go back down to 4,000. We should see 4,100 points. And on the RSI, we have also breached below the 70-point overbought level, now reading at 59, so it's healthy. We also see some kind of stabilization from the downtrend that we saw last week today, hence I'm not too worried. So for people looking at getting into the STI index, 4,100, 4,030 points, these are the two key levels to watch over here at the lower part of the Bollinger Band, which we should see some technical support coming in the near term at least. Okay, next let us move to the US indices. So like I said, the August period or the month of August is usually one of the weakest months throughout the year, especially on the US side. It is usually the weakest month for the Dow Jones Index. So we saw the start of the tariff being kicked in on 1st August, and we also saw the job report that Gerald mentioned earlier that caused the big pullback, the over 2% drop for all three major US indices last week. Okay, so we are now resting on the 50 days moving average for the Dow Jones Index at 43,434 points, low bound of the Bollinger Band at 43,800 points. So we are right in the middle at the closing last Friday at 43,588 points. So I am also not too concerned about the US indices. Okay, there are a few reasons, so let me state them one by one. First thing first is in the immediate short-term view, we can see that the closing last Friday on the major US indices that I'll go through later, you can see that we actually closed above the market lows that we experienced. So that means that there are actually traders coming in to sort of buy into the market towards the closing of the US indices last Friday. Okay, so that is the first sign of confidence and support. The next thing is we are also at a crucial 50 days moving average at 43,437 points. So that is also the next technical indicator that will offer support. Even though we see that the job numbers came out pretty badly, the sort of the rate cut probability as stated on the CME FedWatch 2 is likely going to be cut in September with an over 80% probability right now. So that could provide another catalyst for the US indices as well. So I think these are some of the key reasons that could support the markets further, okay, the US market further. So the next support level for the Dow Jones Index will be the red line that you see here. That is the long-term 200 days moving average at now 42,882 points, okay? So I would say 43,000 will likely see some technical support bias coming in to sort of support the Dow Jones Index. So why do I say that? The negative reading on the MACD indicator suggests that there's still further downside, so at least a 500 points down, closer to the 200 days moving average at 42,800 or 43,000 level. And the RSI has also swung below the 50 points average, 50 points midpoint. So we are at 42-point reading, so we have not gone into the oversold level of 30 points yet, which is something that we saw in the April tariff period as well. So I'm waiting for this scenario to repeat itself on the RSI, and that could be my first buy signal on the Dow Jones Index. And then let's say if we get a confirmation, that means the crossover of the MACD above the signal line, that would mean that we are back on a rebounding track for the Dow Jones Index to track higher again. Okay, so there might be a bit of fear in the market right now, but don't be clouded by some of the headline movement. look out for your analysis, your fundamental technical analysis to support some of the calls or some of the buys that you want to get in, especially when market volatility is high, that gives us the opportunity. Next, let's move to the S&P 500. So the same thing, you can see that last Friday candle, we had a very big drop nonetheless, 1.6% drop. But then you can see that we actually closed, the S&P 500 actually closed above the low of that last Friday session. So we are still inside that channel, the Bollinger Band channel, channel. So that means it is still within the expected volatility of the broad index. So last Friday closing at 6,223 points is actually above the low bound of the Bollinger Band at 6,196 points, or the 6,200 level, with the 50 days moving average now at the 6,129 points. So I think support would definitely come in around the 6,150 points level. So about an 80 points drop below, that would trigger some of the buy signal coming in from technical traders, okay, with the uptrend still intact. The MACD indicator is negative, so do expect further downside, at least for this week, with the big CPI data coming on Wednesday. And the RSI is at slightly below the 50-point neutral mark, so we expect it to go down slightly further towards the 30-point oversold level. Similarly, on the RSI indicator, do sort of look out for the pattern of the RSI hitting below 30, like what we saw in the April period. That would be the very good sign that, hey, we should start getting in back into the index again, where value will start to appear again on the broad S&P 500 index. Next, on the Nasdaq Composite Index, so you can see that even though the Dow Jones Index and S&P 500 are hitting very close to the low bound of the Bollinger Band, Nasdaq, supported by some of the big tech earnings last week, is still pretty much above the low bound of the Bollinger Band at 20,354 points. Last Friday closing 20,650 points level is about sort of a 200 points, okay, above that. And then you can also see the low bound, the 50 days moving average in blue at the 20,090 points level. So definitely the 20,500 points level would definitely see some support coming in as well, with the low bound of the Bollinger Band at 20,354 points. So MACD indicator slightly negative, so more downwards pressure. So we don't see a very big trajectory downwards, so that's not of a concern. So that means that if it hits any technical rebound level, we should see support coming in to support the uptrend that we have been seeing in the past few months. The RSI indicator is more or less neutral now at a 50-point neutral mark, but with the negative MACD reading, with some the big economic data coming in on the CPI, we do expect further volatility, especially if you look at the VIX index, is sort of a slightly elevated right now. So the RSI might trend further, but the same thing, we are looking for the RSI to go below 30 for the Nasdaq Composite Index before we start to buy in again, and that is the scenario that we see in April and early part of March as well. Okay, so key levels to watch for the Nasdaq Composite Index: low bound on the Bollinger Band 20,300, and the 50 days moving average at 20,200. So these two key levels could be some of the key support levels that you should watch out for to get back in on the US indices, given that the corporate earnings or the earnings season so far that I see is still pretty strong. So I think we can sort of withhold or withstand the recent headlines of the tariff pressure and the job numbers, with the expected rate cut coming in September, that could maintain the index towards the all-time high again. Okay. And these are my takes on the major indices this week. Anything else you need to add, Gerald?
So I think we have seen some of the developments in the market, but this week we have the CPI data coming up, more earnings in Singapore, particularly for DBS and UOB. So those are the things that I'll be keeping a very close lookout for to understand the direction of the markets.
Yes, so like what Warren Buffett said, we need to be sort of greedy, or I would say we need to keep our heads up when market is volatile, and such a pullback usually represents some kind of opportunity happening in the market. So do your due diligence and grab the opportunity to get back in on the market. And in the meantime, we'd like to wish everyone a happy National Day, happy birthday, Singapore. Any wishes for Singapore, Gerald?
Yes, so happy National Day to all who are in Singapore, and hope to provide you with more updates in next week's weekly market review.
Yes, so good. Hope to see everyone next week in the next weekly market review. In the meantime, stay safe and trade safe, and we will see you in the next one. Goodbye.